Hope everyone is doing well. Let me just check one thing on the audio. As always, feel free to go ahead and ask questions. I will try and answer them first come, first serve. So, overall, we had a fairly big gap on the day, and the market gapped up. And typically, whenever you get a gap, usually the market will go it will usually go sideways to down and then get an attempt at a second leg up. A gap from here to here is a breakout. Give me just one moment. Okay, I got that fixed. But anyways, a gap up is a breakout, and breakouts typically have second legs. So bull breakout, odds were we would get a second leg. But then we got a really big bear bar on bar two. Bar two is enough of a surprise that when you see it, you know the odds are we're going lower. Bulls, they bought the close of one. They probably scaled in lower. A lot of bulls would exit on the close of two. Two is a big enough bar. It's trapped traders who bought below one. And then three, it's another big bar. Two consecutive big bear bars. Is it sell to close? It is, but you're testing near the bottom of the gap. So we in essence have a big rally up to bar one and a big sell off, big up, big down, probably going more sideways. Three or four, another big bear bar, but with the tail on three, I suspect probably buyers down here and profit taking. We probably will get below one. However, we may get a pullback first. It was reasonable to buy below one. And you know what I'm going to say? Whenever it's reasonable to buy below one, whenever you have a reasonable bar like buying below one, typically those traders can buy more lower. Some of those traders might buy more below three. And six, we have an inside bar. Generally speaking, inside bars in strong breakouts lead to lower prices. However, with this much selling, and it's probably what you have to wonder, what you never know, whenever you get a strong breakout or sell off, it's a vacuum. You just don't know where the support is. It's a vacuum test of support. And we don't know where the support is, but we know it's somewhere down here. So there's probably buyers somewhere in this area, at least for bounce. And then six is a very big bull bar, and it's a surprise. Surprises typically get two legs. And on days like today, we have a surprise down and a surprise up. We know two things are likely. One is the bull bar on six is probably going to get a second leg up. And then number two, we know that the bear breakout to the downside is probably going to get a second leg down. So when you see the close of six, is it buy the close, sell the close? You can sell it if you're willing to scale in higher, and you can buy it if you're willing to scale in lower. Bulls will buy, betting that the first reversal down will fail and will probably go a little bit higher. But I suspect the upside is probably limited. It's possible we get up all the way back to the one low, but it's kind of like this right here. Whenever you get a big bar, typically it leads to a second leg. And even this bar here, we had a big sell off. This is not near as big as the open of today, but it's a big sell off. Even though we went above the bars, we still had a second leg down. So the odds are today will be either a bear trend or a trading range day. It's a little bit hard to argue with the gap up because really we've had an equally strong gap and an equally strong sell off, which makes me think a trading range day is most likely. Another big bar on seven, almost undoing the damage caused by the first three bars or the 4 bar sell off here. I suspect probably buyers below seven, scaling in lower, buyers below eight, and the first reversal down will fail and we'll get a second leg up. And then we got this bar right here, and you can see it tested the one low. So a lot of traders who bought below one, scaling in lower, getting out, break even in this area. Probably buyers below this bar for a second leg up. Just like bar 1 was a bad bar to buy below, bar 5 is a bad bar to sell above. That means there's probably sellers above scaling in higher. And the reality is the bears who sold above 5 and scaled in higher, or the bears who sold, will probably be able to make money, just like the bulls who bought below 1 and scaled in lower. 9, we have consecutive bear bars, probably buyers below, and at least a small second leg up. You can see some bulls, they bought the 7 close, disappointed on 8, and they used 9 to get out, break even. And then we had 10. 10 was a big give up bar. It's a surprise. Surprises typically have second legs. And the bears who sold the 5 high scaled in higher, like sold below, let's say 9, they're making money. The problem with big bars is they often lead to trading ranges. So traders will sell, they'll sell here, but when they start to see buying pressure, like here or this tail or even this inside bar, they start to take profits. Why would they take profits? Because they know, they think about it like this. So here's the sell off. And what's more likely? Are we going to go all the way down here? In other words, what's the risk reward? Are we going all the way? How far down are we going to go before we pull back? So if I sell down here, what do I have to risk? And if I'm selling here or buying, who's more likely to make 10 points? Is it more likely to go down 10 points or up 10 points? And you have to wonder, 50% pullbacks are common. It may rally 10 points before it goes down 10 points. Same thing here. Big bull bar, probably going to go higher. But at this point, we know the risk reward's bad. It's bad. It's not ideal to buy the close of 7, stop below 6. Therefore, if it's not ideal to buy the close of 7, stop below 6, we know that the odds are the buying is going to be limited. Traders are only willing to buy high if the momentum is strong enough that it will carry them further. And then when it starts to hesitate here, traders begin to take profits. Why would they do that? Simple. Because if we could fall below 6 and still have buyers down here. So it's a really challenging trade. It's like selling here. If anything, you need to be able to sell more in this area, and most traders don't want to do that. Give up bar, so bears made money. Bulls, they're trapped. So the bulls who bought the 9 low and scaled in lower are trapped. And then we have 10, a bull inside bar, 11, a bull inside bar. 10, big enough bear bar, probably a second leg down. And 12, you can see it's testing the 10 close. Are there buyers below 12 or sellers below? There might be more buyers below, but I suspect they're scalping. We still have a pretty big sell-off. We have a big enough surprise. Chances are we're going to fall below the low of the day. 13, allowing the bulls who bought the 11 close out at break even. They buy the 11 close, buy more lower, getting out, break even. And then 14, a big bear bar testing the low of 10. And then 15, we obviously had a big surprise breakout. Now 15, is 15 the start of a bear trend, or is it going to lead to a leg in a trading range? I suspect 15 is going to lead to a leg in a trading range. We had a lot of buying pressure in here. And what that means is there's probably bulls buying somewhere down here. It sounds crazy, but traders they'll buy a pullback, maybe in this area, and they'll use a stop all the way down here, betting that the market will test back in this area before it goes down there. And then you can see we started to stall. We tried to break below yesterday's low, tried a second time, and you can see we're trying to reverse up. 18, we're trying a third time. And then we have a bull bar, a bigger bull bar, and then a bear bar. Probably buyers below 21 and at least a small second leg up. But it's possible 2 legs up. We went up on 16, down on 17, up on 21. So it's possible low 2. but probably buyers below and probably going to get back in this area. 22, 23 consecutive bull bars. Is it by the close? It might be, but you're at obvious targets. The 11 low, the 10 close. This is an area where bulls got trapped. 24, it's an inside bar and probably buyers below, scaling in lower, and probably at least a small second leg up after 22 and 23. However, look at this rally compared to this sell-off. We have a big sell-off and a big rally. So probably more sideways. Big down, big up, big confusion. Probably going to go sideways in this area. The other problem is risk reward. If you're buying, where's your stop? Well, you can put it below 22, but the reality is there's probably buyers below 22. So it's probably somewhere down here. And a lot of traders don't like the risk reward. If you're buying here, 1 times your risk is up here and your stop's down here. So it's really a bad area to buy. Traders would rather look to buy a pullback. And then we have another big bull bar. So we had a breakout bar on 22 and 24 and 23, pullback 24, second leg up 25, and then a bear bar. It's technically a parabolic wedge. We went up, pulled back, up again to 23, pulled back 24, up again on 25. So it's parabolic wedge at an obvious target, probably buyers below 26. However, parabolic wedge and a 50% pullback from the high of 8 to the low of 16. This could be an area where bears start selling. 27, you can see what happened. Bulls bought the 25 close, disappointed 26. They used 27 to get out, break even. 28, a doji, and then 29, a bear bar closing on its low. Probably buyers below, scaling in lower. And then 30, another bear bar. Now we have a 4-bar micro channel, tight bear channel, probably buyers below, and this rally will get at least a second leg up. But it's a parabolic wedge. 1, 2, 3. Therefore, you have to wonder if it will lead to an endless pullback. The bears hope this is just a leg in a trading range and that we fall all the way down here. Ultimately, the bears want a double top with here and one of these highs over here, and to break below this neckline and a measured move down. 31, 3 consecutive bear bars breaking out to the downside, 50% pullback from the rally from 17 to 27. But with this much of a sell-off, probably sellers above and a second leg down. And then you can see on 32, another bear bar, probably buyers below and more sideways here. And then 33 going sideways. You can see there were sellers above 32. Bull bar, so it's an inside bar, second entry buy. But tight enough channel, first reversal up may fail. Follow entry bar or the follow through bar after 34. But it failed to close above 33, and it's hovering just below the moving average. So there might be more sellers in this area. And then 36, we have a doji. And then 37, another doji. And then 38 is a bull bar, but it's a doji. So the market sold off and rallied, and there might be more sellers above than buyers. If the bulls need a surprise, they need a strong upside breakout so they can test up to here. And if they fail to get it, we will probably go a little bit lower. And then there were sellers above 38, 39, test the moving average. You can see we sold off, broke below 33. We're testing down in this price level here. Still probably buyers below, but bear channel. So you have to wonder if the market may try and go a measured move down. We went this far from here to here below the low of 4. So you have to wonder if we'll try and go somewhere down here. 4 consecutive bear bars, a pullback, no sign of a higher low, major trend reversal, or a good double bottom, and the bears got an endless pullback again. By 45, we have 6 consecutive bear bars. Probably buyers below, probably sellers above, and more sideways. But then we have an inside bar on 46, and then 47 we have a give up bar. 47, it's enough of a surprise. It's probably going to have a second leg down. The bears want the measure to move down. They might get it, but I suspect we're extended from the moving average. 3 pushes down. Probably an area where traders will take more profits than look to initiate shorts. And then 48, we have another bear bar, pull back on 49, and a second leg down on 50. And then 51, we have a bull bar. So we have consecutive sell climaxes far below a lot of trading range trading. And typically, whenever you get a lot of buying pressure on the open and a lot of selling pressure, in other words, you're in a trading range, when the market, especially when the range is fairly big and the market tries to break below it, typically the breakout fails and more trading range price action continues. So on 51, I would certainly get out of shorts. Bulls will buy, taking a chance that we rally back to the 16 low. It's kind of like right here, second entry buy. Bulls will take a chance that we close the breakout point below 4. 52, decent bull bar or entry bar. You can also call it a stairs pattern. It's basically a broad channel, even though this final channel is fairly climactic. So 52, bull bar, 53, another bull bar, probably buyers below. Is it by the close? It probably is, but bulls probably need one more bar. We're just above, we're right at a target where some traders will begin to take profits. And then 54, 55, it's still by the close. 55, a little bit of exhaustion, but after 5 consecutive bull bars, probably by the close, scaling in lower. And you can see it pretty much remained by the close. Tight bull channel, so sign of a strong breakout. First reversal down is probably going to fail, so probably buyers below 56 and 57. Until bears can make money below bars, bulls will assume it's a small pullback trend. And then 60, 61, 62, it's still by the close, so traders will keep a stop, maybe a point or 2 or 3 below a bull bar. Bear bar on 54, but it may just be profit taking after the 6 bear bar on 64, but it may just be profit taking after the 63 by the close bar. 63 is a little bit climactic, so it'll yield some profit taking by the bulls. High one buy on 65. In general, there's usually sellers above high ones, but this channel up is so tight, and we have targets above the high of 25, this area in here, which we're pretty much at. We also have the low of 9 and the close of up here. It was reasonable to buy the 9 low. And because of that, bulls will probably make money. Why was it reasonable to buy the 9 low? Because after 6 and 7, the bulls should have gotten a second leg up. Trading ranges are notorious for low probability events happening. So 10 was a low probability event. It's a little bit subtle, but it trapped bulls into buying below a bar that should have had a second leg up, and instead it broke to the downside. And since those bulls never had a chance to get out break even, the market will probably retest that price. And when it does, it will probably find sellers. High one buy, but then 66 closed on its high and the market continued higher. 69, tight bull channel, still, you can argue a wedge, 57, 63, 69, still probably buyers below, scaling in lower. And then 70, we have a bull bar closing on its high, getting close to the target, the 9 low. And then 71, another big bull bar. And we pretty much just went sideways in the close and pulled back. Whenever you get this, 70 and 71, most traders will look to take profits, especially after consecutive buy climaxes, with 60, 70, and 71 being bigger than usual. For always in today, for always in, it's probably sell the close on 2 or 3, But then bears, unfortunately, they probably get out on the close of 6 or maybe 4 or 5 points above 5. Bulls, a little bit tricky. Bulls can buy the close of 7, but if you're buying the close of 7, you have to anticipate that the odds are we'll get a deep pullback. Typically, the market does not immediately reverse. The market does not typically reverse a big sell off like 2, 3, and 4 and 5 without letting the sell to close bears out at break even. So the sell to close bears on 5 never had a reason to exit the trade. And because of that, that increases the risk that we will have to get down to the close of 5. That will lower the probability of buying the close of 7. So bulls buying the close of 7, they're really buying high in a trading range, which is not ideal. But had I bought the close of 7, I think you get out as 10 starts to form. And then on 10, you can sell the close, but that's not ideal either. What do you think these bears are thinking here when they see 6 and 7? They're disappointed. And if those bears are disappointed, a lot of those bears are going to buy back shorts. And that's why the market bounced on 11 here. The size of 10, probably second leg down. So bears could sell it, or they could sell a pullback. And then when they see 14 being another bear bar, a lot of bulls gave up on the idea that the market was going to form a double bottom there. And then traders gave up during 15. 15, it's always in short, but it's 2 legs down after it's 2 legs down, nested within 2 larger legs. So leg 1, pullback, leg 2, nested within a larger pattern, leg 1, pullback, leg 2. Probably buyers in this area, and the market's going to rally and probably go sideways. Bears get out above 18. Aggressive bulls buy, betting that this gap closes, or they start buying 19 or 20. But if you're buying 20, you're buying the breakout point, and the market will probably try and pull back. Anybody that's long after 25, they either get out below 27 or after maybe below 29 or 30, especially 31. Bears start selling on the way down. Do they get out on 34? Some of them might, but I suspect that after the sell-off and the channel being tight to 32, probably a second leg down. So probably more sellers in here. And then bears. Bears are short. Bulls, no reason to buy yet. No good buy signal bars. It's basically a parabolic wedge. 38, 42, 45, and the market broke strongly to the downside. Whenever you get a parabolic wedge and you look at it and you say, oh yeah, it's a wedge bottom, but the wedge bottom is very tight, that's a warning that it's a breakout on a higher time frame. So here's that same wedge. And do you really want to be selling? Do you really want to be buying above a micro channel that's lasted from 1045 to 1215? Of course not. The odds are there's probably sellers above. So at this point, I think traders would be willing to get out 4 or 5 points above a bear bar. But the best the bulls can realistically expect is sideways. And then we broke strongly to the downside. We got a second leg. Bears, they get out above 51. Bulls start buying. Bulls certainly start buying in here. No reason to get out anywhere in here. I think maybe bears would get out or bulls would get out probably 2 or 3 times the size of that bar down, which would be more than a minimum scalp. No reason to get out in here. Same thing here. So 57, 63, and 69. Parabolic wedge top, but very tight channel. So probably buyers, more buyers, and any pullback will be minor. So it's kind of the opposite pattern we had down here. We had a wedge, not in great shape, and then we had an upside breakout in the second leg. We have a wedge, not great shape. We have a downside breakout in the second leg down. For stop entries and for the bulls, I would just get out somewhere in here. For stop entries, you can sell below 2, but it's more of a sell to close market. Buy above 6, but it's, I think, at best a scalp, and hard to buy in here. If you buy above 18, it makes sense betting the gap closes, but hard to do. I thought the best stop entry was 51. Consecutive sell climaxes 1, 2, and 3. So it's a wedge, and it's a wedge here 33, 45, 46, or 48. So I thought it was okay to buy above 51, betting that we get a rally back into this area. So 51 is probably the best Walmart trade of the day. Limit orders, you could see bulls who bought the one low and scaled in, 15 points lower, actually made money. But whenever you see a sell off like 2 to 5 and then a rally like 6 to 7, the odds are it's probably going to be a trading range. And bulls are buying X number of points below bars, bears are selling X number of points above, and especially selling 2 or 3 legs up. So you look at this, it's a bear channel. Bear channels are notorious for becoming always in short and then reversing, always in short, sideways. 15, back to always in short, and then a reversal up. Then the pullbacks become always in long. So always in long on 20, maybe. Always in long 22, 23, probably. But then when you see this, you have to wonder if that is too late in the move to be buying, and then you get a sell-off. But for limit orders, probably sellers above 32, buyers below 49, and buyers below 56. And there were several other limit order trades today. Buy the close, sell the close, probably sell the close 2, 3, and 4. But if you're selling 4, you got to be quick. And then if I was short, I would get out, maybe 5, 6 points above a bear bar, certainly on the close of bull bar. Probably buy the close 6, buy the close 7. But if you're buying the close of 7, you got to be quick to make decisions because there's the risk of 10 happening. Probably sell the close 10, better if you can scale in higher. Sell the close 15, but if you sell the close of 15, what do you do with 16, 17, and 18? I think most traders have to be pretty quick to get out. Buy the close of 19 or 20, but aggressive. And even bulls bought the close of 21, bought the close 22, 23 for a second leg up. Sell the close of 30, 31, probably okay. And probably sell the close of any of these bars in here. Sell the close 47. What about selling the close 48? I would not. You're getting pretty extended, and the odds are we're going to close this gap and probably profit taking here. Buy the close 52, 53, 54, 55, 56, any of these bars. You can even buy the close of 59, betting on higher prices. So what do we do? Where do we go tomorrow? Well, I think that today is a reminder of all the trading range trading we've had. The bulls rallied. We had a pullback, and then we rallied on the day session, and then we got a strong sell-off. So you can see we're very neutral on the daily chart. Let me take a look. Questions. Okay, question. I bought. Get rid of that. Question. I bought 51 today. Exited half with 5 points. So I bought 51 here. I think that's good. Exited half with 5 points. So they bought 15 even. They took part off here for 5 points. I would, I think that's okay. And the rest for 10 points. We went a lot further. So the point is, let's just read the question. They bought above 51 today. They took part off at 5 points and the rest off at 10. We went a lot further, but after the close of 54, I did not want to be long. Should I have held on for longer? So the context made sense for a deeper rally with all the buying pressure we had today. My only problem with taking part off at 5 is the bar itself is only 4 points tall. Yes, your actual risk was small, so the trader equation works out. But at that point, I would be a little more willing to give it a chance. You have breakout points above. You have a sell climax, 46 through 48. So we probably will get to the moving average. I would at least wait and see what the entry bar looks like. And then when this bar looks like it is, you know we're probably going to go a little bit further. But in general, what you did was, for the most part, okay. Which book to read? I would start with the video course and then maybe the trend book of Al's. But let's try this. So they just this person said they just imagined that today's market started as a trading range, correct? And after an hour to an hour and a half, I know the upper third and lower third of the range. And when the market gets up to the top or the bottom, I start trading in the opposite direction, even though the market's having good sized trend bars. After the market closed, I feel like I'm gambling, trading like I'm afraid it will become a bad habit. So let me think about your question for a second. Yeah, so you're basically fading breakouts you're talking about, and it's okay to do it. You see a big what I would look at is legs. Strong bear sell off, you know you're going to get a second leg. Therefore, even though you see 6 and 7, there's two things on the open. One, you have a big sell off here, and odds are you're going to get a second leg down. So there's probably sellers above. You also have a big gap up, and the odds are the gap will get its own second leg. A gap's a breakout. So we rallied during the Globex session. It would be easier to see this on BS because the breakout was pretty recent. But you can see we had a big bull breakout and then a big sell off. You know, this rally should get a second leg. And in hindsight, this right here was that second leg. And then we got a downside breakout. You know, it should get a second leg as well. And in hindsight, this was the second leg. But going back to your question, just showed the Globex just because it's easy to see the breakout since it happened on a report. But in general, if you're selling up here, I think that's okay. I would be hesitant to sell the close of 7 just because it's a big bar. But after maybe 8 and 9, I think it becomes more reasonable, especially if you can scale in higher. And then you see a big bar like 10, it's a surprise. It'll probably get its own second leg. And just like 3, 4, and 5 should have its own second leg down. As 15 goes down, you know traders are buying, betting that this breakout will fail. 2 or 3 pushes up. Once you get 2 or 3 legs, traders start looking to sell. Maybe they sell the high around this area, and then we sell off. And then you get 1 leg down, probably going to get a second leg down or go sideways. And even here, big bear breakout, but after consecutive sell climaxes, traders started buying. So I think what you did's okay, as long as you're not fading first legs. Question: at what point did you conclude the reversal up was not a minor reversal? Is today a good example of a V bottom? Yeah, people always ask that. Is this move a V bottom? Is this sell off and rally a V bottom? Is this a V bottom? Is this a V bottom? And I don't think any of them. I mean, yes, they're V bottoms if you want to really classify them like that. But the whole point behind Al saying that V bottoms don't exist. Yes, they exist, but what he's saying is it's a poor definition. There's a better way to classify a V bottom. In other words, here's a leg 1, pullback leg 2, triangle, failed breakout of a triangle, big bear bar, but we had a bull flag here. We broke below it. Leg 1, pullback leg 2. Here we have 3 pushes down, and then consecutive sell climaxes for the third leg. Big sell off, and then a second leg. So it's a double bottom. And for the bulls, it's climactic. We broke below the lows of 45. We broke below the low of 16. Probably buyers below, scaling in lower. And for me, I thought this reversal had the potential to at least get to the 45 low and the 16 low. But then when you start to get 4 or 5 bull bars and the bears clearly not making money, you know it's becoming a major reversal. Plus, we had all this buying pressure in here, here, and here. So the chances of this becoming a small pullback bear trend and lasting all day was very low. What is a mathematical way to calculate whether the bulls or bears are making money? What's the minimum in terms of points? I think about it in terms of the bar of the bars. So for me, when I look at this sell off and then I see 6, I know it's obvious 6 bulls made money on a stop. If you bought above 5, you clearly made money. When I look at 9, let's say the 9 low is 5 points. On the way down, I know it's clear bears made money. 18, bulls have not made money from 8 all the way down to 18. But then you see 19 and 20 or 21, you know they made money buying. Type bull channel, possible start of a small pullback trend, but it's also a possible parabolic wedge. 1, 2, 3. If this is going to be a small pullback trend, the bears should not make money below bars on stops. So maybe this bar, let's say it's 5 points, the bears should not make a 5-point sell off. So it shouldn't go down to here. And you can see it did that. So if you sold below here and you put a stop above 26 or 25, you clearly made 1 times your risk. Over here, let's see, the bears failed to make money here. If you sold below this bar stop up here, you did not make money. You did not make 1 times your risk. And you didn't really make money until up here at the end of the day. So for me, it's general. For a day like today, it's probably 4 or 5 points. But I just kind of keep it simple, and I just look at on the way down. Here's the size of this bar. Okay, bulls made money. Here's the size of maybe this bar. Bears made money here. Size of this bar, so maybe here. Bulls clearly made money on 20 on 20. So that's kind of the way I measure it. I just really eyeball it. And I do it that way because it simplifies. I mean, obviously, if it's Forex, the minimum needs to be a minimum acceptable profit. So on a 1-minute chart, if the average bar size is 3 ticks, then that is not an average acceptable minimum. So on Forex, if my minimum is 10 pips, and on a 5-minute chart, the average bar size is 3 pips, I'm not going to say, oh, well, the bulls made 3 pips. This bar range was 3 pips, and the bulls made 4 pips. Therefore, it's no longer a small pullback trend. You can make that logic, but, in general, I just look at the bar size. Why did you measure bar 2 through 5 as the measured move rather than 8 and 15? Yeah, when I made, for one, because it's the first leg down. So I thought that, there's 2 things. One, it's the first leg down. So measured moves typically will happen on the first leg. I did not have this. I didn't think we would get down here. The reason I had this measured move was I was trying to make a point. This range is 39 to 67. It's a fairly big sell-off, and it's fairly climactic bars compared to the past 100 or 200 bars. These first bars 2, 3, 4, and 5 are fairly big. Well, 2, 3, and 4 are fairly big compared to the past several bars. Therefore, I thought there was an increased risk of a deep pullback, especially bar 1. There should have been buyers below 1, and that increased the risk of the market being in a trading range. Also, small pullback trends do not typically look like this. This is the sign of something that's climactic and that's going to not last the whole day. You want sustainable moves, and if something goes too aggressive, then it usually will not last. Follow up, can I measure from bar 25 to 16? Yeah, why did I measure bar 25 to 16? I thought it might be a double top. And the bears, if you sell below 27, they may want a break below the neckline, 16, and a measured move down. This is just an area of trading range trading. So we have a high, another high, we have a low. If the bears are lucky, they'll get a measured move down, which is basically a bear breakout below the trading range. Yes, you can call it a stepping pattern. I agree with that. Question I've noticed in a trading range, it will often try to form a lower high and break below the bottom of the range, then reverse to near the high of the range like today. Is there logic to this? Yeah, there's traders just scaling in. So a range is, let's take 6 and 7. The market rallied on 6 and 7 and it sold off to the, let's say, 6 low during 15. So traders will see this as a trading range and the battle will commence for a measured move of this range going down or the market going back to it. And a lot of traders, they'll buy in the bottom of the range, scale in lower, and scalp out. Same thing here. You know, this could take. The problem with that is if you're buying the low of 6 and you scale in here, a lot of traders will scalp out here because if it's a bear channel, what do you do here? You don't want to get stopped out down here. But you can see, even the traders that were long here, this actually, let me try and elaborate a little bit on this. This is buying pressure. And eventually what happens is you break below the neckline, you sell off, and then you rally beyond the breakout point, the 4 low. Same thing here. We broke below the neckline of 16, went below it, but then we rallied significantly higher. And the reason is, if you think about it, there should have been buyers here. Strong enough rally, strong enough rally. There should have been buyers below, and we probably should have formed a trading range here. So bears disappointed at the 18 high. They sell the 18 high, they scale in. There should be buyers. And you see the market tried to form buyers, tried again. But the bulls started to fail. And we ended up breaking to the downside. And a lot of traders, they'll use a real wide stop and they'll start scaling in pieces. And they may argue there were buyers from this distance here, the 4 low to the 16 low. So it'll probably will not fall the same distance lower. So there's probably buyers somewhere down here, but they're probably not, it's probably not going to fall much below this line. I hope that answers it. On the measured move up, which bar should be used? You just pick a bar. So I start with the first leg. First leg ended probably around 57, but you can see, maybe it's from here to here. That's one target. Or you could say to here. There's another target. And you don't have to, you could say this. Ultimately, it was the low of 51 to the breakout point. You don't have to measure it like that. You can look at the bars. Strong rally up to 57, probably a second leg up likely. 4 or 5 consecutive bull bars to 63, really 4 bull bars, probably a second leg up likely. And then the market went sideways. Is break even usually at a 50% pullback? Can it be 33% or 66%? Sure. It just really kind of depends. The bulls that bought here, usually, it's common. 50% is common. Bulls that bought here and bought more lower, maybe they got out break even. But for me, I think a lot of traders, they bought here, they would just take the loss on this bar. Some traders, they bought here. You can see they couldn't get out. This is also a challenging place to buy because of the strength of the sell-off. You can see that. Let me find another example. Some bulls buy maybe the 13 low more above a bull bar. Break even was during 21. So it really just kind of varies. Do you know the best way to read pullbacks? When to expect larger pullbacks or smaller pullbacks? It depends on the context. In general, more buying pressure you have in a bear channel, eventually you're probably going to get a strong rally. Here, you had a lot of things going for the bulls over here. The bears were probably exhausted on 48 and 50, so that increased the chances of a strong reversal. Plus, you had all this buying pressure here. So, when you're reading pullbacks in general, so what is the best way to read pullbacks when you expect larger pullbacks or smaller pullbacks? Generally speaking, it's the strength of the trend. And the tighter the channel, the more narrow the pullbacks, or the weaker the pullbacks, the less bars the pullback should last. The broader the channel, the more complex the pullbacks. And you've heard Al talk about it. In a bear channel, especially a broad channel, so in other words, a trading range that's tilted down, the market will typically become always in long right before it reverses. And it becomes always in short at a new low just before it reverses. Always in long 22, 23, but then it reverses. Always in short sideways, becomes always in short here, and then clearly always in short here, but that's when it reverses. So that is how I generally think of pullbacks. When you see a candle like 72, do you see that as selling pressure down or bulls making an attempt to push higher? So when I see a bar like 72, do I see that as selling pressure or bulls pushing to make an attempt higher? I see that as more profit taking. So look at 72. And there's something I was going to say with that. Anyways, doesn't really matter. 72 is testing in this area right here where bulls were buying. And that's going to be an area of resistance. The bulls buy the 7 close, they scale in lower, they get trapped at this red line. And you can see there's profit taking. So to me, when I see a bar like 70 and 71, it's a gift for the bulls, and bulls will start to sell. 72, it's more traders scalping out and bears selling above bars than traders selling below bars. But there will be probably sellers above 72. So why bar 51? What's the probability behind it? Yeah, it's consecutive sell climaxes. 3 pushes down, 33, 45, 48, 6, 16, 48. Sell climax down to 48, second leg down to 50. Bull bar closing on its high, and after consecutive sell climaxes with a lot of trading range trading, odds are we're probably going to enter a trading range and go sideways. Do I think 13 is a good trade to be short? I thought it was okay. The odds were the Bears would get a second leg down after 10, but you never know. We could have easily tested back up to here, but it's reasonable betting that the Bears would get a second leg down after 2, 3, and 4. Is buying 38 for a swing trade reasonable? You can, forcing you to buy in the middle of a tight trading range just under the moving average. And you can see it's a trading range bar. So for me, had I bought above, had I bought above 38 and then I saw 39, I might be inclined to just take a small loss. The doji 38 is not a big bar. It's a small doji, which means there's probably sellers above. But there's also buyers probably below 38 as well. And you can see they got trapped. So they tried to buy the 38 low during 41, and they got trapped on the way down. So how would you assign probability based on the time for that trade? It's all about the context. I wish I could give an easier example with that, but context means everything in the world of probability. Big sell off. Yes, in general, odds are you're going to get a second leg, but it's a big sell off in a tight trading range when the bars have been small, so we could get a deep pullback. Bar one's an important bar. It's a bull bar, so that means the breakout below bar two is a surprise. It went below one, and there should have been buyers below one, so that lowered the probability. The fact that bar two went below one and the bulls that bought below one never had a chance to avoid a loss lowers the probability for the sell off. I didn't think we would rally all the way up to here on the first try, but that is a piece of context. Bar 7, consecutive bull bars, is generally high probability for a second leg and a measured move. However, when you get bar 6 and 7 after a big sell off, that is not necessarily high probability that you're going to get a strong second leg up. It's high probability that you're going to be in a sideways market. My broker only allows me to trade the Globex or ETH chart. Therefore, they can't trade the ES.D. What should I do? Yeah, you can trade the Globex just fine. But I'd be shocked if your broker doesn't allow you to trade the ES.D because the data is supplied from the CME, which means if your broker has data to the CME, they probably have the ability to look at the ES.D. But anyways, here is the 5-minute chart of the Globex market. Surprise breakout, follow through, buy the close, and then a second leg up. Consecutive bull bars here, buy the close. Then you get this tight trading range. With this big bear bar, bulls will use any bounce to start selling. And then you get the surprise bar here. Probably enough of a surprise going lower. This many bars down, followed by this big of a rally. Probably going to go sideways, but probably sellers above. Consecutive bull bars, but the bulls who bought in here, disappointed by the sell-off, they'll use this rally up here to get out around break even. Plus, the bears who sold here should get a second leg down. And then the rest is really all I talked about on the day session. So if I was trading this, I would just trade it the exact same way. I wouldn't trade it any different. Okay, last question. So second leg is high probability. Is that what you're saying? How about a third leg? The second leg, after a first leg down, breakouts almost always have second legs. So whenever you have a leg one like this, usually you're going to get a second leg. Here, it's a breakout. It's a surprise. 10, it's probably going to get a second leg. What about 15? It's a breakout. Probably will have a second leg, but it's 2 legs down. Leg 1, pull back, leg 2. Second legs are common in trading ranges, and they're often traps. Surprise breakout, 44, 45, 46. Maybe it reset the count. So now, instead of being in a bear channel down here, we're in a bear breakout. But you could easily just get one more leg down, and that's it. An easy example is 51 to 57. We were in a bear channel, and then we get this strong rally. Odds are you're going to get a second leg up. And you can see the second leg up was fairly tight. All right, that is all the time I have today. I hope everyone enjoyed this and found it helpful. As always, you can go to the Brooks Trading course to learn more information. And I'll have another one of these videos tomorrow at the same time. All right. Hope everyone has a good rest of their day.